Okay, last week we started this paper. Hey, we did question 1, part B. Am I right? It was segments. We did the segment recon. Oh, yeah. You're going, no, we didn't. But then you remember that we did segments, and then I said we may as well do that segment recon question. So we have done question 1, part B, which was the segments piece. So today we are doing question 1, part A, which is earnings per share and employee benefits. Let's have a quick squiz at the question, at the required. Okay. So this is the required. Oy vey. So although it says employee benefits, it looks like we have to do a calc on employee benefits, adjust the profit, and then use that profit to work out the earnings per share, because this is the required. Basic earnings per share, 22 marks. Basic headline earnings per share, 6 marks. So no dilution, just a basic. We know that with basic, it's a very simple calc, isn't it? It's profit attributable to ordinary shareholders over weighted average number of shares. The profit attributable to ordinary shareholders is after pref divs. And it could be pref divs paid, it could be pref divs not paid if it's cumulative. For the weighted average, we know that we sometimes have adjustments for share issues or for cap issues, or sometimes there are even rights issues. And that's what adjusts the weighted average. But now the question did talk about employee benefits, and I remember the students who wrote this. Do you remember, what was that short guy? He was friends with you. No, Caleb. I remember wasn't he friends with you? Caleb. Yeah, well, compared to the other three, he was shorter than Tibbs, wasn't he?
He's shorter than me.
Yeah, no, he was short. I remember him coming to me after this paper and saying, there was this a lot of employee benefit stuff, but there was no required. I don't know what I was supposed to do with it. But anyway, I don't know what he did, but he did parts. But it did confuse him. So let's just look quickly at what the information is that's given, just so we can get a feel. So we get given profit numbers, and we get given a capital structure. So far it looks like we could start with a basic earnings per share calc straight from here. Remember, we start with this number, hey, not NCI, attributable to ordinary shareholders, to the owners, to the parent owners. And then we have a capital structure, ordinary shares and non-redeemable prefs. It looks like there was a dividend paid and declared and paid. So out of this shareholders for the parents, some of that profit went to pay a pref div, so we must remove it. They had a rights issue of 1 for every 5. The exercise price was R2.80. Fair value for the shares was R3. So there's going to be a piece that's free. Do you remember how to do that? A piece that's free and a piece that's not. The piece that's at full value gets weighted according to the months from November up to year end. The other piece is free, so we just do the apportioning, isn't it, on that calc? If you don't know what to do, shout. I'll show you what the calc, where to find the page in your study guides. We haven't done this for a while. And then, let's see what else they say. They issued... Then in February later, they issued some shares at full value. They utilized these shares to acquire an interest in a solar technology company. We actually talked in MAC the other day about mergers and acquisitions and how we fund acquisitions through share swaps, isn't it, or share issues. So it looks like this is what that was. The financial accountant calculated the profit for Sol at 4744414. I don't know why we would be interested in the profit for Sol. But this is the key thing here for this one, is these dates. We issued the shares on the 1st of Feb, but we only acquired control of the assets on the 1st of March. We're not going to use that date. We're going to use this date, isn't it? We use the date that the consideration is received, not the date that I issue the shares. Because when I receive consideration, that's when profit goes up. So that's that one. The issue of shares and subsequent acquisition have not been yet accounted for in the accounting records of Sol. Oh, okay. So we have to consolidate. Sheepers. It's a bit weird, huh? The issue of shares and the subsequent acquisition of the interest have not yet been accounted in the accounting records of Recharge Limited. An impairment loss of 500 relating to goodwill was included in other expenses. Okay, so it looks like we might have to add this profit in for the portion of the year that it was a subsidiary. And we only put in our piece of it. Do you agree? So we start with the 50 and we put in our piece of this profit for the portion of the year that it was a subsidiary. We adjust the profit by that. I would do that, although it seems to not be very clear, but when you read it, you'll have to see. The issue of shares, so there was an impairment loss which has been accounted for in other expenses, so that we don't need to worry about. The following items were included in profit before tax for the year. So these numbers are included in there. Depreciation, loss on sale of machine, impairment loss. This is for what? Headline earnings, isn't it? Headline earnings. So headline earnings per share, HEPS, is capital items. We're looking to adjust capital items. So they've given you some items which may or may not be capital in nature, and you'd have to adjust it to go from basic to headline earnings. We issued options to the public. This transaction has not yet been accounted for in the books. But on 1 July, we issued options for each share. On 1 June, the average price was until 1 June. Okay, here is the piece that comes into my basic earnings per share calc. Some of the options were exercised in the current year. So in the current year, there were options that were exercised, and so therefore there were shares. There are shares that are issued. Do you agree? We haven't been asked to do diluted earnings per share. I don't have to do that whole diluted earnings per share calc with the share options. The only thing that's relevant here is the fact that there were options that had been issued in the past that in the current year have been exercised. Share capital goes up, yeah, from that date. 75% of them, so that you can adjust as well. I still have yet to see employee benefits. Okay, Recharge engaged in salary negotiations with the trade unions during March. The gross salaries amounted to this before the agreed increase. An increase was agreed with the trade union. The salaries, including the increase, have been correctly processed in the accounting records. Okay, so there's nothing to do there. All employees are entitled to an annual bonus based on gross salary for the financial year if the share price increases by more than 10% that year. The bonuses are payable once the financial results are published. The share price was R2.80. The shares traded at R3.10 to June. I'm sure they're going to say something about the fact that it hasn't yet been accounted for. The bonus accrual the previous year was this. The bonus payment was made. The payment was accounted for by deducting. The bonus must still be accounted for. So there's the bit that needs to still be done. Yeah. Remember how it affects profit? Yeah. It's what goes into P&L is any change in the bonus provision plus any bonus paid in cash. Yeah. So any bonus paid in cash, the way that we do that entry is we just say debit, whatever credit, debit, expense, credit, bank, and then any movement in the provision also goes in there. Otherwise, you can say provision at beginning, what was paid, any difference goes to P&L. If we look at it from a provisions perspective, right, from FAC3701. I had this provision, this is what I paid. What I paid too much or too little lands up in P&L. And then at year end, I've got to raise a new provision, whichever way you want to do it. So we have to adjust profit. We have to adjust profit by how this bonus is going to affect profit. The bonus accrual for the year end must still be accounted for. So look at what they did. They actually told you what they did, actually. So you can go and have a look. The payroll records reflect a leave days of 5 days not taken by employees. Here it is again. The accrued leave pay for the year ended 30 June has not yet been accounted for in the records of Recharge. Yeah. The SA normal tax is that. Okay, so the way that I would approach a question like this is, you know what you have to do. You have to do a basic earnings per share and a headline earnings per share, right? So you know that there are a couple of calcs. You have to do basic profit, you have to do weighted average number of shares, and then you have to do the adjustment to basic profit for headline earnings, isn't it? So you start with basic and then you do your headline earnings adjustments. So do you agree 3 calcs? So I would set up the 3 calcs, and then as I go through the question, then I would make the adjustments. I would just do them on separate pages, I think. Or you can do them half a page, 3 half pages. And then on the second half of the second page, you can start your workings from there. Looks doable. I know that employee benefits is not a favorite section, and that you're probably thinking, what the heck was all that? But try it. Yeah? The theory or the principles are not difficult for employee benefits. And the calculations, it's not something major that I taught you that you've never seen before. So it's just applying the principle that they've got and trying to figure out what should my provision be at year end, both for provision, for bonuses and for. Okay. I don't know what happened now. I've printed. Okay, let's have a quick squiz at the adjustments that I made. So profit attributable, I started with the number given, adjusted for the pref div. I also brought in the profit of that subsidiary sold. I brought it in for 4 months. I brought in 55%. I then put in the bonus adjustment and the leave adjustment, which I'll show you the calcs for, and I landed with a basic profit of 51. On the number of shares, I start with the shares given at beginning of year, 4.5. Then there was a rights issue. It happened 4 months into the year. There were 7 months left. It happened in November. The at value piece was R2.80 out of R3, so that worked out to 840. The difference, 60, is the free piece. This at value piece is for 7 months. It apportions for 7 months. And then I'll end up with those numbers. Then this number, the 56, is the same proportion. I've applied the same proportion. But I did see you all had it. Then we issued some shares for the acquisition of control. I took it from the date of acquisition of control, which was 1 March. And then we exercised some options. That happened right at the end on the 1st of June. And it was 75% of the options were exercised, so I put them in for a month. You see that they made it easy for you. They made the options exercisable at the full R3, isn't it? So it was, the price was R3, exercised at R3. There was no free piece to mess around. That's something that you'll see at honors level. Then headline earnings, we start with basic profit that we calculated. We impaired, there was goodwill impairment, which we reverse. There was a loss on sale, which we reverse, and there was impairment on something else that we reverse. The depreciation stays in. Yeah, we don't adjust for depreciation. We'll end up with that headline profit. So the reversals are to add back these expenses, all of them. Okay, then the bonus calc, they gave you salaries as at March, and then they said from April there was an increase. So you had to work out an annual salary. It was 9 months up to March, and then the 3 months from April to June. You worked out an annual salary. The share price at beginning was R2.80, at end was R3.10. The increase is 11%. They said if the share price goes up by 10% or more, then the bonus is 10% of the annual salary. So there's my bonus, 466,303. So beginning of year, the bonus was 420. I paid 407,500 out of that, so I was left with 13, because they told you they took the bonus out of there. So at end of year, then my bonus needs to be 466. So I have to put a P&L charge in of 453. That's the number that you saw pulling through to Calc 1. Yeah. Then we have the leave. The leave was so easy, wasn't it? So easy, the leave. I've got it here, the leave. They said to you there were 5 days outstanding, but they expected they would only take 3.5, so we only provide for the 3.5. At a daily rate of 84,500 gives you leave accrual of 295,750. Beginning of year was 163, so the P&L charge is 132. I initially did tax, and then when you read the very last line, it says that you must assume that the tax is correct after all of these, so they don't want you to have to do tax adjustments. They should have let you just do the tax adjustments, isn't it? Because it doesn't make sense that they've done the tax, but they haven't done the calc. I mean, that's stupid. Who does that? Okay. So then, statement of comprehensive income, then the calc. The calcs are here. Basic earnings per share then is the 51,073 divided by the 5.6 million shares, and then headline 51,788 divided by the 5.6. R9.11, R9.23. Be careful, the question asked you to disclose the two, basic earnings per share and basic headline earnings per share, in the statement of comprehensive income for the year. So it looks like that. Total comprehensive income, whatever it was. They didn't ask you to put that in, so I didn't bother to try and work it out. Basic earnings per share from continuing operations, 9 Rand 11. Basic headline earnings per share from continuing operations, 9 Rand 23. Easy? It wasn't too bad, huh? All right, the next question is question 2. It's a 32-mark question. It asks, let's just go back to, no, let's leave it here. What kind of question is it? It's a government grants and borrowing costs. So let's see what they ask for. Usually they just ask for disclosure. It says, required A. The financial manager has emailed you several questions regarding to borrowing costs. Prepare memorandum. So there are 3 questions. There are 9 marks, so 3 per question. 3 points per question around the theory around borrowing costs, right? Remember that with borrowing costs, let me just go back. The theory of borrowing costs is easy. It's the calculations of the interest that's a pain in the bum, isn't it? So what is the theory of borrowing costs? The theory is, if I have borrowing costs for a qualifying asset, that's the first thing. It has to be a qualifying asset. Then I ask myself the question, do I have a specific borrowing or do I have a general borrowing? Do you remember that? If I have a specific borrowing, then I look at the interest paid minus any interest received, and that's the amount that I can capitalize as a borrowing cost. Capitalize into asset. If I have a general borrowing, what I do is I take the costs incurred times the interest percentage. And if I have more than one general borrowing, I use a weighted average interest percentage. Yeah? And that's the amount that I can capitalize into the asset. Now, the calculation problems come in calculating this interest paid, because when I'm calculating the interest paid, I have to worry about how much capital I'm paying interest on. Did I get all the money up front, or am I getting it in pieces? Yes. I have to worry about when I got it, beginning of the period, end of the period, throughout the period. Because that changes the interest number. You remember doing that, isn't it? So if I borrowed the money at the beginning of the month, I pay interest the whole month. If I borrow at the end, I don't pay interest that month. If I borrow throughout, then I divide by 2. And then I also need to worry about how interest capitalizes. Or let's call it compounding, because then we use the word capitalize for too many things. I have to worry about compounding. Does interest compound? And if so, when? What does it mean interest compounds? I add it to the capital, isn't it? But these things about the interest calc apply there, and they also apply here when I'm doing the interest calc here, isn't it? I also have to ask myself, when were the costs incurred? Was it at beginning? How much was incurred? Was it at beginning, end, or throughout? And what is the compounding period on the interest rates there? So that's borrowing costs. So the first required here asked you to do the first required here asked you to give some discussion. So hopefully that should be enough to deal with that. Remember, it's practical. You're just answering the questions. So I'm going to leave you to try and do that. Then B asks you for disclosure for 32 marks. They want you to disclose the following notes to the annual financial statement, the profit before tax note, and they want you to include interest in there. Sometimes we have a separate note for finance income and finance expense, but they want you to put it all in there. So what do we expect to see in this PBT note? Interest income and interest expense and interest capitalized. We also expect to see things like depreciation, isn't it? And yeah, that's pretty much probably it for a government grant. Oh, maybe there could be amortization of government grant income. And then they also want the PPE note for 20 marks. And then C, disclose the amount that will be disclosed as deferred tax. Oh, okay, deferred tax. So the way that I suggest that you do that is try and leave a few minutes, 5 minutes or something, before you meant to be finished this question, and then do the rest as much as you can, because you know with deferred tax, whatever the balances are that you've worked out in B, you're just going to pop them into a deferred tax calc, isn't it? That's all it is. And what is the issue with deferred tax and borrowing costs and government grants? Well, if the grant is taxed, it's taxed right at the beginning. So then there'll be deferred tax because of that. The borrowing costs will be allowed as soon as the asset is brought into use. So if the asset is not in use, then we have pre-production interest. It's a deferred tax asset. If the asset is in use, then I've already been allowed the tax deduction for the interest, whereas I've put it into the asset, isn't it? So I'm going to have deferred tax once again. Okay. So, but it's only 3 marks, so it's not going to be massive, huh? That one. Right. So let's see how far we can get with that question. We have just half an hour. I have a dead phone, that's what I have. I've been putting off buying a replacement for my calculator because I keep thinking it will show up somewhere. But I don't know. You know, when you misplace something, you always think, oh, maybe it fell in the car between the seats. The next time it goes to get cleaned, somebody will find it. But somehow, the worst thing is when you replace something and then you find it. So I don't want that. Okay, let's have a look at the dates. There's millions of them, huh? But I think the key ones. 1 January 14, we gain approval for the loan. Okay, so from that date, we would have been able to borrow the money if we had expenses that needed to be covered. That was the date of the loan. Then the first date they give you to do with the project is the 1st of March. The 1st of March, there are plans that are complete. Construction activities actually only commence the 31st of March. But remember that we're talking about activities which go beyond construction, isn't it? So any activities where you are incurring expenses, that would be part of that activity. So plans the 1st of March, construction the 31st of March, then finished and available for use the 31st of October. Only brought into use the 1st of December, and then our year end is 31 December, isn't it? So if we look at the dates, what we know is that we're going to, the first question asks you, when do you start capitalizing, when do you stop? I always draw the timeline for these, because you have to understand when is beginning of year, when is end. That also happens to be beginning, 1 Jan. So I'm going to start capitalizing when the 3 things are met. I have to have been incurring interest. I have to be incurring costs. And I have to have started activities. And those dates match on the 1st of March. Do you agree? So from the 1st of March until the asset is available for use, which is the 31st of October. It ceases when it's, they talk about substantially complete and ready for use. So we're going to capitalize from 1 March to 31 October, which is 8 months. 8 months. So we're going to capitalize 8 months. There will be no interest, I think, on these few months at the beginning, because we're only going to start borrowing the money when we have to pay the engineers, the 1st of March. And then, or they've given us, actually, I didn't look at that. The first invoice is the 1st of March. Okay, I need to be careful with that. The first invoice, I just looked at the activities and I didn't look at the costs. So the first invoice is the 1st of March. So that's where we're going to start. And then from the end of October to the end of the year, for 2 months, there will still be interest, isn't it? It's just that that interest is going to go straight to P&L. Yeah, so we're going to have interest from 1 March all the way to year end, up to October, capitalized into the assets. From October onwards, not capitalized into the asset. Question B asked you between the specific and the general, which basically was what I was telling you before. So with the specific loan, interest capitalized is interest incurred, less any interest earned if the funds are received up front. On a general loan, it's based on the expenses incurred at the interest rate for the loan. Then C asked you, what would happen if there was a 10-day strike? So the rule usually is that, and that's what I've said there, if we suspend activities, we have to suspend capitalizing. So if you decide, you know what, I'm going to go to Mauritius for a month, I'm not going to work. For that month, you can't capitalize then. If you're not going to be building the asset, you can't capitalize. But the statement does also give you the so that does give you an out, because what it says is, if it's not within your control, that suspension, then you shouldn't be penalized, isn't it? So it says, if it's something that's an act of God or something that's not within your control, you as management can't control it, then you can carry on capitalizing. So if your conclusion, therefore, is that the strike is outside of management's control, then you should be able to continue capitalizing. Okay, so I suppose it depends how long the strike goes on. A 10-day strike, you can argue, is not within management's control. A 2-month strike, then management maybe is getting a bit difficult with the unions, and they're not doing their best to try and sort it out either, isn't it? So we've seen some of those in this country recently. So that's the first part. So then it doesn't look too bad, right? It's just we need to do all the calcs. I did set up my template. So it looks something like that. In my profit before tax notes, I'm going to have interest income, which is going to be all my interest received, which in this case, I don't think there was any. Didn't see any references to interest received, but in case there was any, less interest capitalized. Then in my expenses, I'm going to have the government grant. I haven't checked yet what the policy is for government grants. It says they deduct it from the amount of the assets, so that also won't be there probably by the time I clean it out. Then in my expenses, I'm going to have the interest expense, which is the total interest paid, less what's capitalized, giving me the expense, and the depreciation. In my PPE notes, I haven't yet put in the government grant, so that still needs to get put in. But I've got additions, and I've got borrowing costs capitalized. I'll have to put in a line for government grant. May as well put it in while I'm here. So I'm going to start with a zero balance. I'm just going to move that down. That's the best. So it'll probably start with nothing. Then I'm going to have additions, 15 million, I think it is. Then I'm going to have a government grant, I'm not sure how much. And I'm going to have the borrowing costs that I've capitalized. And then I'm going to depreciate for 2 months the assets ready for use from October. Yeah. And then I've got some calcs here for the specific loan. I've got some calcs for the general loan, because there's going to be a time where I'm going to have used up my specific loan. So I'm going to start with specific, yeah? But the asset's going to cost 15 million, and my loan's only going to be 12. But I'm actually going to hit it before I even reach 12, because I'm going to have capitalized or compounding interest, isn't it? So I'm going to compound my interest, and as I compound, I'll see that I will hit 12. When I've hit 12, then the rest must come out of here. Any interest that's coming on that 12 must also come out of here, because I can't go more than 12, isn't it? So I'm going to do 2 separate calcs. I know that in the study guide they've got a question where they try to do it all in one, but I think that's very confusing. So I'm going to do 2. One for the 12, and then one anything above the 12 is going to go into that one. And then here's my government grant, which I've said here as deferred income, but it won't be. I've got a repayment here in my template, but I don't know if there is a repayment. Oh no, they're just saying that they met the conditions, so it looks like there's no repayment, so I won't have to worry about that. In fact, I probably won't need this at all, because if there's no repayment, there's nothing to calculate, isn't it? So this I probably won't need, but you know what, I'm going to just leave it in case. I'm just going to delete this part, because there's no repayment, and I'm going to delete that. But I don't know, I just need to read more carefully if it's deferred income or not, because the government grant can either land up there, or it can be separate. I just need to check carefully the policy. So that we can finish next time. I will see you next Monday. And then we've got the lecture set up for which is when? In May, which is the week after. But we should be able to finish this one by next week. We've got to finish this question, and then which should take another half an hour, I imagine. And then we've got the leases question. Leases and related parties, it says. But it wasn't a bad paper. You sometimes see these papers where it's like a big question, 60 marks, and then a small one for 30 something. Those are, harder.